Imagine this. You've been saving up for years, but instead of growing, your money is quietly losing value thanks to inflation. Why? Could it be because of where you are saving or investing your money? Most likely. I believe that just leaving your money in a savings account could be one of the worst decisions you are making. Hi, I'm Shay, a financial educator based here in Canada, and over the past few years, I've met so many clients who are lost when it comes to investing their money. They feel overwhelmed by all the options or simply don't know where to start. So in today's video, I'm going to walk you through the 7 best investments you can make in 2024, especially if you're new to investing. Whether you've just arrived in Canada or you've been here for a while and are unsure what to do with your savings, this is for you. Let me tell you, one of the most common mistakes people make, especially newcomers, is leaving their money sitting in a regular savings account. You think it's safe, right? But every year, inflation chips away at that balance. So, how do you stop that from happening? How do you get your money to work for you instead of just, sitting there? These are 7 investments that I have offered to clients based on their investment need and risk profiles. Let me start with the first client, which we will call the mutual fund newbie. So picture this. A young couple walks into my office. Let's call them Ali and Priya. They've recently moved to Canada and they've saved up a decent amount of money, but they are not sure where to put it. Ali is like, Shay, we don't know the first thing about stocks. Priya nods nervously. I suggested mutual funds. It's perfect for beginners who want diversification but don't want to put their monies in individual stocks. Think of it like this. You're pooling your money with other investors and a professional manages it all for you. Less stress, more spread out risk, I told them. The beauty of mutual funds is you're not putting all your eggs in one basket. They loved that idea because they were both too busy to monitor the stock market. But I also had to warn them. Those management fees can sneak up on you. I remember telling them about another client of mine who didn't realize just how much the fees were cutting into their returns. Always check the management expense ratio, or the MER, before diving into mutual funds. They were very satisfied with my suggestions. A few days later, I had another client, Sarah, in her 50s, close to retirement and looking for security. Sarah isn't a big fan of risk, so I brought up segregated funds. They are similar to mutual funds, but with an insurance twist. Here's the amazing thing about segregated funds. They offer a guarantee. Even if the market goes south, you will still get a portion of your initial investment back. Sarah was relieved to know that at least 75% of her investment was protected if things took a dive. Plus, segregated funds have benefits like creditor protection, and they are handy for estate planning. So for someone like Sarah, who wants peace of mind, this was a solid option. And if you also want some security with your investments, segregated funds will be the best way to go. Note that they are often offered by insurance companies and not banks. Now, meet Jason, a 30-something tech worker with a bit more experience in investing. Jason likes to have control over his investments. So, I suggested ETFs, or exchange-traded funds. ETFs are similar to mutual funds, but they trade on the stock exchange just like regular stocks. I said, Jason, this is where things get interesting. ETFs are low cost, flexible, and you can buy and sell them throughout the day. Jason was intrigued because he loves the idea of having more control and making moves quickly without paying hefty management fees. I remembered asking him, do you like the idea of being in control? Or would you rather take a hands-off approach? That helped him realize that ETFs were a great fit for his style. I love ETFs as well, as it gives you a bit more control. So if that's your style, definitely go for it. I must also mention that you can have a mix of these investment types by not putting all your eggs in one basket. Please always remember that. The following week, Emma walks into my office. Emma doesn't like risk at all. She's what you would call a bond person. Bonds are essentially loans you give to governments or corporations, and in return, you get regular interest payments. Emma loved the idea of steady, predictable income without the roller coaster of the stock market. I told her about a friend of mine who is also into bonds. They don't like the ups and downs of the stock market. So bonds give them that sense of calm, knowing their money is safe and growing at a predictable rate. So if you are like Emma, someone who values stability over high risk, bonds might be your answer. This is especially good for people who may have retired or who need their funds at a certain time and don't want to risk any kind of volatility. Also, if a little dip in your investment has the tendency to give you a heart attack, this might be the best option for you. Now, let's talk about stocks. Stocks offer the highest potential returns, but also come with the most risk. I had a young client, Laura, who was really excited about stocks, but terrified of losing money. I told her, look, buying stocks is like owning a piece of a company. Some days it will be up, some days it will be down. But if you're in it for the long term, the rewards can be huge. Laura was nervous, just the way I was when I bought my first stock. I told her about my own experience. At first, it feels like a gamble, but over time, you learn that it's all about patience. If you can stomach the risk, stocks could offer you some incredible returns. Again, stocks are not the investments that you'll be checking every day. No. That will make your heart skip too much. It is for the long term. So if you are not a long-term person, consider another kind of investment. I usually have my clients ask, what is long-term? Well, it's relative, but I would say as long as 10 years and above. If you're planning to use your funds for something soon, the stock market is not a suitable investment type for your funds. Next up is REITs, or real estate investment trusts. Not everyone has enough cash to buy a house or commercial property, but with REITs, you don't need a down payment. I had a client, Grace, who desperately wanted to invest in real estate, but couldn't afford to buy a property in Toronto, which is where she really wanted to buy. I told her, with REITs, you're investing in real estate without actually buying property. It's like owning a share of the rental income without the hassle of being a landlord. Grace was thrilled because for her, as little as $50, she could start investing in commercial or residential properties. REITs also pay dividends, which can provide you with passive income. If you want me to make a more detailed video about REITs, please indicate in the comments below. Also, if you are getting value, remember to like the video and subscribe for upcoming videos that can help you build wealth no matter the country you live in. Okay, now here's the part that really seals the deal on these investments. No matter which option you go for, you can make them work even harder for you by using a TFSA, a tax-free savings account. With a TFSA, all your gains, interest, and dividends are tax-free. I told my clients, whether you're investing in mutual funds, ETFs, bonds, or stocks, holding them in a TFSA means you keep all your profits. It's a total game changer for long-term wealth building. However, there's a limit to how much you can contribute into a TFSA each year. I told Sarah, Jason, and Emma to check their limits, and they were all blown away by how much more they could be saving just by using a TFSA. So if you haven't maxed out your TFSA, you are definitely leaving money on the table. These are the 7 best investments you can make in Canada for 2024. We've covered everything from low-risk bonds to high-reward stocks and everything in between. Whether you're a cautious investor like Emma or a thrill seeker like Laura, there's an option for you. And remember, the key to successful investing is knowing your risk tolerance and having a long-term plan. It is so important for investing. And for all you stock investors who have invested in the stock market and are probably panicking because stock prices are falling, check out this video next to find out the best things to do in this situation. If you found this video helpful, don't forget to like the video and subscribe to the channel. See you in the next one. Bye.